All right, let's get another perspective here, because joining us to help us break down this 4-day trading week, which include a couple of fresh record highs, is Kayla Cedar, State Street Global Markets macro multi-asset strategist. Kayla, it is good to see you. It seemed like, Kayla, what you're suggesting is when you looked at the big jobs report today and other economic data you've been reviewing, you seem to be saying, Kayla, you've seen an economy that, okay, it's cooling, it's moderating, but it's still, in your opinion, looking fairly and relatively resilient and strong here?
Yeah, thank you so much for having me. I think that's definitely right. We have this kind of moderation that's going on, this direction towards moderation, but the actual level is still quite strong. And so, I think what that means is, as we're assessing this data, we have to put some of this moderation into context. And so, yes, you have a headline figure in the NFP print today that was still above pre-COVID norms. But then you do see some signs of weakness underneath. However, if we take a step back, wage growth is still quite strong. JOLTS data implies that there are more job openings rather than there are folks unemployed. And so when you bring this back to monetary policy, yes, this means September is live, but thus far it looks like the economy is still perhaps too strong to expect the cut in the near term.
Do you think it's just too strong period and we might see a risk of reacceleration up, which would mean maybe the Fed is on pause a lot longer than people thought, or GASP even has to raise rates? That seemed to be a possibility a few months ago, but admittedly it's been priced down quite a bit from then.
Yeah, I think it has been priced down because the data has started to move in the direction towards easing and moderation. So that means that the bar for a hike is higher than the bar for a cut. With that said, though, I think you point out a really important factor to consider is that the Fed certainly does not want to cut and then have to hike again. And so I think that's why when we look at the underlying data, especially in the CPI prints, we want to start to see services and housing make progress back towards 2%, because otherwise there is that risk of reacceleration.
Kayla, another big economic data point next week, CPI. What are you looking for there, Kayla? What's your expectation?
Yeah, one thing that we have insight into at State Street is we have price stats, which is a daily measure of goods inflation. And so when we look at the progress made on goods inflation thus far, that's really what has led a lot of this disinflationary move lower. And so I think that means two things. One, we need to start seeing more progress on the services and housing side, and we also can't see goods reaccelerate. And so what we're seeing thus far is that goods inflation is continuing to move lower. We are seeing disinflation continue. And so that's a good sign moving into next week. But again, we also really need to start seeing those housing OER figures start to come down. And we'll also be looking for a continuation lower in Supercore as well.
What are the big macro headlines that you might be a little bit concerned about? Things not necessarily front and center right now, could be geopolitics, could be election, the things that might cause some perturbances in the market in the months to come.
I think the market does have this habit of getting ahead of itself. And so that's what makes this transmission of, I would say this movement in some of the data hard to grapple with, because we do see weakening, but is it weakness? And so I would caution folks from getting too excited about some signs of moderation and interpreting it as weakness and expecting too many cuts. Unless we're really going to start pricing in a recession, which thus far looks unlikely, it's going to be hard for the Fed to really deliver this this large magnitude of cuts. And so it's much more likely, I think, that we're going to see a shorter and relatively shallow cutting cycle.
So Kayla, add it up for us, given your view of the economy and the Fed. For investors listening right now in the stock market, Kayla, what do you prefer?
Yeah, I really prefer still large cap quality growth, which really still means tech. As we approach earnings season, which is going to be kicking off next week, it really does look like tech is where majority of the earnings growth is going to be. As we look forward to the rest of the year, expectations are that earnings will continue to accelerate, but revenues will decelerate a little bit. And so when we think about, okay, what does that mean for sector allocation? That's really an okay story for tech, because what that means is they can still support profit margins without some of this revenue growth, given their borrowing costs, given their cash flows, things like that. And so they're very well bolstered to navigate that kind of environment.
All right, got to leave it there, but appreciate your insights here on this quiet Friday afternoon. Thank you, Kayla.
Thanks so much for having me.